Okay, traders, once again, we're going to be talking about selling put options because, the more I make videos about selling put options, the more questions I get from viewers. So I want to make sure everyone understands how to do this strategy. I consider it the greatest option trading strategy ever because I love selling put options, and I think it's a great way to create income for yourself and or potentially buy a stock that you want to buy. Now, what we're going to do today in this video, I'm going to explain what selling put options are. I'm going to show you the cheat sheet, and then we're going to look at option chains for SoFi and Tesla, two very different price stocks, but very good for selling put options because implied volatility is very high. So they have very juicy, what I like to call juicy premiums when you sell these things. Okay, so I'm going to go over how to sell these put options, what kind of account you can use, how much money you can get from selling these put options, what kind of returns you can expect. I get a lot of comments here in these videos. A lot of people ask me, why are you suggesting these stocks, or what kind of returns can I get, or why would you sell that? That's a horrible return, whatever. I'm here to show you the strategy. I'm here to teach you. I make these free videos. So let me show you how to do the strategy, and then you can decide if you want to do it for yourself, okay? I'm not here to tell you what to do. I'm here to show you I'm here to educate you and teach you about a great option trading strategy, okay? So let's just jump right in. All right, everyone, Lee Lowell here from smartoptionseller.com. So here's the cheat sheet, selling put options. Let me just kind of go through the list here and talk about what the strategy is, and then we will look at the option chains. Number one, if you don't know anything about selling put options, it is an option trading strategy. In the options trading world, you can either be a buyer of an option or a seller of an option. We concentrate on being the sellers of an option. And one thing you need to know when you sell an option contract is that you do not need to own that option contract prior. You can just sell a put option or a call option, whatever, but in this case, we're selling put options. You can sell that put option as your initial transaction. You just basically create the option out of thin air. Okay, so you do not need to own the option prior in order to sell it. This is the initial transaction, okay? The second thing is when you sell an option contract, you are selling it to somebody else who is the put option buyer, and they are paying you for that put option contract. So you're creating instant upfront income for yourself. I want you to understand, think about selling put options like an insurance company. And we're going to talk about home insurance, for example. When you buy a home, the insurance company sells you the insurance policy on your home, and they collect their premium from you typically on a yearly basis. And what they do is they're hoping that your house does not burn down so they don't have to pay out to, build a new house. So they sell you the policy, they collect the money from you, and they, wait typically a year until you have to pay again. It is the same thing with selling put options. What you are doing is you are selling someone else, the put option buyer, an insurance policy on their stock, because if they buy a put option, they're basically buying protection on stocks that they may currently own, or they're just buying a put option because they think the stock price is going to go down. So what you're there to do is sell them an insurance policy, basically saying that if the stock price does go down, I will be there to buy that stock from you. Okay, so you're basically selling an insurance policy to somebody, you're collecting the money, and if the stock falls, you are there to potentially buy the stock from them. Okay, they will sell the stock to you. That's how put options work. That's how selling put options work. Okay, so if you are selling put options, let's go through the list real quick. You are being paid to buy a stock, or I should say you're being paid to potentially buy a stock in the future. You don't know whether you're going to buy the stock yet until the end of the expiration period. Okay, so I want to make sure everyone understands that right up front. And you should be bullish on that stock. Okay, make sure it's a stock you're comfortable buying at a price that you're comfortable with. Once again, you only want to sell put options on stocks that you know and that you are willing to buy and that you are able to buy and you would be happy to buy, because bottom line is you may end up buying shares of stock. After you sell that put option, there's only two things that are going to occur. You're either going to buy that stock or you won't. But in either case, you will always be able to keep the money that the put option buyer paid you from the very beginning of the transaction. The only way that you'll know is if you have to buy the shares of that stock is if that stock falls from its current price on day one to where it falls to on expiration day. And we don't know how it's going to turn out. Okay, so you always have to understand that when you sell a put option on a stock, you're picking the price in which you would be comfortable buying that stock. You're not going to be buying it at its current price right now. You're going to be buying it at a price sometime in the future below the current price of that stock. You have to pick that price. That's what's called the strike price. Okay. So whatever stock it is, make sure you're comfortable with that stock first, and then pick a level, the strike price, in which you would be comfortable buying that stock sometime in the future, and you get that money paid to you up front. Okay, right here, follow me here. Do not sell put options on random stocks that you know nothing about. Okay, now that you understand that selling put options, you can sell a put option and collect this money from people, do not think that is a good way to make money on random stocks that you know nothing about, because before you know it, you're going to end up buying shares of stock that you don't want, that you don't like, that you don't know nothing about, and that stock could keep tanking on you, and you're going to be very unhappy with that. Okay, so only choose stocks that you are willing, able, and wanting to own for the future and potentially for the long run. Down here, in order to sell put options, you must have a brokerage account at a stockbroker and have an options trading account at that stockbroker within your brokerage account. You need option selling approval. If you want to sell put options the way that I'm telling you here, you need to have approval from your broker to actually sell put options. And you have to fill out the application and have them approve you. Okay. And you will also, in that brokerage account, it'll either be right here, cash secured or a margin account. Two types, cash secured or margin account. If you sell put options in a cash secured account, what you will have to do is you will have to put up the full cost of potentially buying 100 shares of that stock right when you sell that put option contract. Whether you end up buying 100 shares of that stock, you don't know until the expiration date, which could be months from now. But yet the broker is going to require you to put up the full cost of buying those shares as if you've already bought the shares. Or you can use a margin account right here, a margin account. If you use a margin account, the broker will only have you hold aside a fraction of that cost of buying 100 shares at the strike price, not at the stock's current price, but at the strike price that you've chosen. I like selling put options using a margin account because why would I want to put up 100% of the cost of buying the shares of that stock if I never know I'm going to buy the stock? Okay? So it's not using my money efficiently, but some people can't get approved for a margin account, so they'll have to put up the full 100%. Okay, I opt for a margin account, but that's completely up to you. Now, if you do end up getting assigned the shares, which means you will be forced to buy the shares of the stock, you will have to pay for the stock in full at that time. Now, if you were using a cash account, you already have that 100% of cash being held aside, so there's no big deal. But if you were using a margin account, you only had to put up a fraction of that cost ahead of time. Come expiration day, if you have to buy the shares, you will have to come up with the balance of the funds to pay for the rest of, the shares, the 100 shares. Okay. Now let's quickly talk about the returns. Now, if the stock never falls down to your strike price, which means you won't have to buy the shares of stock, but you do keep the full premium that you collected on day one. In order to figure out the return on that trade, because a lot of people always say, well, what's the return? Oh, that's such a horrible return. Why would I want to sell put options and collect small amounts of money? That's a horrible return. Your returns are going to be is whatever amount of money that you have to hold aside, whether that's the full 100% or that margin, smaller margin amount, you will calculate your return on that amount that's held. Okay, when I sell put options in a margin account, I'm basing my returns, and when I say basing the returns, let's just assume that the option expires worthless. So whatever cash I collected up front, I'm going to divide that amount into my cash on hold, that smaller cash on hold. I'm going to show you two different amounts. Or you divide that option premium into the full cash on hold. Okay, you're always going to get a smaller return if you have to hold aside the full 100%. Okay. Now, your other returns is that if you do get assigned the shares and now you own 100 shares of that stock, you will have a second return that you have to calculate way further down the road, because now that you have 100 shares and you sell those shares down the road sometime, then that will be your return on the actual shares that you've held. The return on margin or the return on cash secured is only if the option expires worthless. Okay, then that's your return on that small for that shorter period of time. But if you get to buy the shares, now you have another return that you don't figure out until and unless you actually sell those shares of stock, okay? The other thing is that you can always unwind this trade at any time you want. If you've sold a put option on a stock and all of a sudden that stock starts going down and you're like, whoa, I don't like this stock anymore, you get out of the trade. You can always buy that put option back anytime you want, and the trade will be over. Now, whatever you pay to buy that put option back may be higher or lower than what you initially received for it, so it may end up in a profit or a loss. You won't know until that time comes. And lastly, down here, I want to make sure everybody understands that you can lose money when selling put options. The only way you will lose money is if the stock falls. This is a bullishly oriented strategy. If the stock falls, you will lose money. And anybody else that is a shareholder in that stock will also lose money. A lot of people think that selling put options is much riskier than owning stocks. It is not, because the end game to selling put options is that you may end up buying 100 shares of a stock, which would then have the same risk as owning 100 shares from prior. Okay? So don't think that selling put options is any riskier than buying shares of stock. But there is risk involved. The risk is that the stock falls below the price that you end up buying the shares. If you are assigned the shares, you will buy 100 shares. And then the risk is if the stock keeps falling, okay? So don't be under any illusion that you cannot lose money by selling put options. You can. And you can also lose money by holding or owning shares of stock. It is the same thing. All right, so let's jump in. Let's look at the option chain here. Look at a couple examples. We're going to look at SoFi and Tesla. And we're going to see how much money you can get when you sell these put options, how much collateral or margin will be held aside, what kind of returns you can expect. And we go from there. All right, so let's jump into the option chain. Now, I'm using a different option chain here. I typically use Interactive Brokers. On the weekends when I make these videos, sometimes they take their platform down for maintenance. So today I'm using a backup platform, Tradier. Okay, Tradier is another brokerage. You can see right up here where my mouse is, upper left. Tradier is the name of the brokerage. Now, this is their option chain. We got calls on the left, puts on the right, just like your typical option chain. Got all the expiration dates along the top here. And what we're going to do is we're going to look at the January 16th, 2026 expiration right here. This, you can see it right here. Now, once again, I want to say right up front, this is not a real recommendation. This is not a live trade. I am not telling you to go out there and sell put options on SoFi or Tesla. It is an example only. I am showing you how it works, how selling put options work on these two stocks. Okay, don't take this as me saying this is what you should do. It is not a real recommendation, okay? So here we're looking at Tesla options. Right here's Tesla, last trade 404 and change. What we typically like to do is we like to sell what's called deep out of the money put options. The strike price, here's the current price of Tesla. A deep out of the money strike is listed way down here. I'm going to show you right here in the chain. Here's the strike price column. The strike price is the level in which you would potentially have to buy the shares of the stock. So you're in control. You pick the level in which you would be comfortable potentially buying shares of Tesla. Tesla's at 404 and change right here. January, and I'm just picking it as an example. There's no rhyme or reason why I'm using January. Okay, so if you wanted to sell what's called an at-the-money strike, which is the strike price that's closest to the current price of Tesla, 405, okay? And these strike prices are set by the exchanges. You cannot change these. You have to choose one of these strike prices. If you are comfortable potentially buying Tesla at its current price near 405, you can sell what's called the at-the-money 405 put, and here's the bid and ask column. Bid, ask, this is theoretical value. You don't need to worry about that. You always want to concentrate on what the current bid and ask are. So you can see it went out trading 33.60 bid at 33.80. Offer right here in the middle is 33.70. That's the fair value. Okay. If you were to sell this put option, you would get 33.70 per contract. That's $3,370. Whatever numbers you see here, you have to multiply by 100 because there's 100 shares of stock in every option contract. So you would receive $3,337 just for selling this put option contract right up front in your pocket. Now that means now you're obligating yourself to potentially buy 100 shares of Tesla at $405 per share. That would be $40,500 investment at expiration if you were called upon to buy the 100 shares. The only way that you would have to do that is if Tesla actually finished below $405 on expiration day on January 16th, 2026. If Tesla is above that number, if Tesla finishes above 405, you do not have to buy the shares, but you get to keep your $3,370. Now, if you want to look at it this way, your real cost basis would be 405 minus 3370 per share. I'm going to get out the calculator here and I want to give you what your actual cost basis would be. 405 minus 33.7. Your actual cost basis for Tesla would be $371.30. Okay, you take the option premium, subtract it from the strike price. That would be your real cost basis. Even though you would have to pay 100 shares at 405, you're getting this $3,370 up front. So you basically subtract that from the amount you would have to pay if you had to buy the shares. And so your real cost basis is $371. Okay? Now, if you had to buy the shares at 405 and Tesla's still trading around 405, your cost basis is $371. You can turn around and sell those 100 shares right then and there at 405 if you wanted to. And you would lock in your $3,300 or, actually lock it in real profit. Okay? Now, what we like to do is we like to sell put options with strike prices way deep out of the money. Let's just look at this 175 put, for example. Midpoint is around 65 cents per contract. That's 65 actual dollars. If you sell this 175 put option, you're going to get $65 right up front in your pocket. And now it obligates you to potentially buy 100 shares of Tesla for $175 per share. That's roughly $230 cheaper than where Tesla is today. If you go to let's look at the chart here. Let's bring up the chart real quick. And here's the chart of Tesla. Okay. $175. Here's Tesla 404.35. $175 is all the way down here, which is basically the last major support back in April of 2024. So if you're thinking, Tesla's at $404, I would be really comfortable buying 100 shares of Tesla at $175. And in exchange for that obligation, I'm going to get $65 right up front. Now, I know a lot of you will say, and you'll leave me comments saying, why would anyone want to do a trade just to get $65? There's a couple reasons. Number one, because you're giving yourself a chance to potentially buy Tesla at a really cheap price. Okay, you've decided I want to buy Tesla for $175. And the only other way I could do that is if Tesla actually fell down to $175 and then I go out and buy them. But what you're doing is you're being proactive in this case. You're putting your limit order in now by selling that 175 strike put option, but you're getting $65 from somebody else in order for your obligation. Yes, you will have to put up some money, okay? Now, if you are using a cash account for these things, you would have to put up $17,500 just in order to collect that $65. Okay, if you want to sell that 175 put, you got to put up some money. You got to have some skin in the game. So if you're using a cash account, you're going to have to put up $17,500. That's the 175 strike times 100. Now, if you want to understand what the returns could be, if you got $65 for that 175 put, let's go back to the option chain here. Here's the 175 put right here. You get $65 for it. If you had to hold the full $17,500, until January 16th, that's 62 days from now. That's what the 62 number means. So 65 divided by 17,500 it's less than a 1% return. That's why I don't like to use a cash account, because you're holding all that money aside for your $65. Now, if you were to use a margin account, typically when you sell these deep out of the money strikes, the margin requirement's typically not more than 20% of that 17,500. Now, if we go down here, this is the trade. We have this thing. We're going to sell one put option at let's invoke the trade here. Okay, we want to sell one of these things, and it changes down here. Now, this is new to me, okay? Trader, I don't usually use this thing, so this is kind of a learning process for me as well. So we're going to sell this 175 put and collect, we'll get 65 cents. And what you do is hit this preview button, okay? This will show you, come on, okay, here we go. Now, this will tell you how much money, if you're using a margin account, how much money it'll cost you to sell this put, okay? Instead of the 17,500 right here, it's telling you you're going to need, it's either 26.25 or 26.90. Let's use the higher number here. So margin change. So if you're using a margin account and you sell one of these things, your broker's going to hold aside $2,690 instead of the 17,500. Okay. Now let's look what that return could be. $65 divided by 26.90. It's about a 2.4% return in 62 days. Okay, so if Tesla never falls down to 175, that option will expire worthless and you'll keep your $65. And if you're using a margin account, you'd only have to put up $2,690. If you were assigned, if Tesla falls down to 175, then you'd have to pay out your $17,500. But if that doesn't happen, you only have $2,690 to initially get into the trade, or that's how much money you'll have to hold aside. Now, if it's a 2.4% return for 62 days, if you want to annualize that, let's see what that would be. That would be roughly, I'm using the calculator here, about a 14% return annualized. So in order to figure out whether if you're doing pretty good with options trading, if you can get a better return than basically the S&P 500, which is about a 10% return annually for like the last 100 years, or your money market accounts are about 4% annualized. So this is a 14% return annualized on a very expensive stock, okay? So I want to go and I want to do this trade. I want to show you how this works on a cheaper stock like SoFi, okay? Let's pull up SoFi here. And how do we get rid of this thing? I want to get rid of this thing. I don't want to see this anymore. Give me a second here. Okay, I had to figure out how to get rid of that preview page. I had to stop the video here okay, so we're looking at SoFi here, and SoFi is under $28 a share. This is a great stock as well to sell put options on because the premiums are really high. And so let's look at a out of the money put option on SoFi, and I did this example on SoFi in one of the last videos. But once again, let's take a look at, we'll look at the 18 put at this point in time. The 18 put is about 30, you'll get about 39 cents per contract, which is 39 actual dollars, okay? To potentially buy SoFi for $18 a share. It's about a $10 discount from where it is now if we want to look at the charts. SoFi. Okay, SoFi's in a nice uptrend. So you're thinking, okay, I like SoFi. I'd be willing to buy SoFi, but I'm going to buy it down here. Here's the $18 level. Underneath the 200-day moving average, you're thinking, okay, a $10 discount would be fine for me. Now, remember, once again, this is not a recommendation. I'm just showing you an example here. You would be comfortable buying SoFi at $18 a share. And in the option chain, for your obligation to buy 100 shares of SoFi, you'll get $39 in your pocket. Now, once again, people say, well, why would I only want to sell something and get $39? That's like nothing. Why would I even want to, waste my time selling something and just get $39? Because once again, you're obligating yourself to potentially buy a stock that you want at a price that you want. So if you're willing to buy SoFi at $18, someone's going to give you $39 up front. If you were just out there saying, I'm going to buy SoFi if and when it falls down to $18, then I'll buy some. Well, you may be waiting forever. You don't know if SoFi is ever going to drop back down to $18 again from where it currently is. So in this case, by selling a put option, at least you're getting paid money ahead of time while you wait to see if SoFi falls to $18 a share. It may never fall that far, but at least you got your $39 for trying. Now, what you would have to do, if you had a cash account, you'd have to hold aside $1,800. Okay. Now the return is going to be much better because the amount being held is a lot smaller. So the price of the stock really will determine your returns at the end of the day. If you had a cash account and had to hold aside $1,800, your return would be $39 divided by $1,800. That's about a 2.1% return in 62 days. If you want to annualize that, it would be about 12% and change. Not bad on an annualized basis. So if you say I'm only getting $39, well, your annual return's about 12%. Not so bad. Now, if you had a margin account, let's just see how much the margin would be. So let's just say we're going to sell this thing and we're going to get, we want to get rid of, well, we're not going to do this one. We want to get the 18 put, we want to get 39 cents for it, right? The preview would be, let's see how this works this time. Preview, commission, 70 cents, cost $39. And I'm hoping that this is right. Okay, yeah, break even. If you're going to get 39, and this is the preview window. This gives you some information. If you're going to sell the 18 put and you get $39 for it, your cost basis would be $17.61 if you were assigned. Okay, so the margin is $566. If you sold this put option in a margin account, your broker would initially say you have to hold aside $566. This is not a margin loan. You're not paying interest on this either. This is just money of your free cash being held aside. No interest. That's a different kind of margin, okay? So if this trade expires worthless, meaning SoFi does not fall to $18, you'll get to keep the $39. And 39 divided by 566 gives you a 6.9% return on margin held, initial margin, for 62 days. If you want to annualize that, it's going to be times, 8%? It's like a 47% return. 47% return. Let me see, 39 divided by 566. Okay, 7%, 6.9 times 6.9. So it's about a 40% annualized return. 40%. So the lower the stock price, the better return is going to be either on your cash, the full cash, or on your margin. Okay. So stock price does matter when you're figuring out your returns when you're selling put options. Now, once again, if you get assigned the shares, now you have 100 shares of SoFi and you can hold on to those forever. If SoFi goes up to $1,000, you're going to be making a lot of money. Even if SoFi goes up to $50, you're going to be making a decent return. So you have that one return based on the margin requirement or the cash on hold until it expires. And if you do get assigned, now you have a potential unlimited return on the upside. Once again, if the stock keeps falling, you will have a losing trade, just like any other bullish investment. Anyone who bought stock in SoFi is going to be losing money as well if the stock goes down. Okay, there's no illusions here. All right, that's it for that. Let's go back to the cheat sheet real quick. Okay, once again, this is how you sell put options. This is me explaining the process to you. This is all I wanted to show you. I want to give you the education to make these free videos. I want everyone to learn this great option trading strategy. Okay, let's go quickly to our website, smartoptionseller.com. If you want to learn more, I've got resources here, free ebook, all about selling put options. If you want to learn more, get this free guide. Scroll down here, put your name and email address here. We'll send you an email back with a link to get this free guide that I've written. If you want to take a deeper dive, you can look into our video series. It's a 5-hour video series, deep dive into selling put options, what it's all about. Along with that, you get 30 days free to our newsletter where we actually sell put options. And you get access to our probability calculator for 30 days as well. Services tab right here. So that newsletter is just talking about, you can just join the newsletter if you want. We have a naked put selling newsletter. We have a credit spreads newsletter. We have a coaching if you need a little help. Take to the next level. If you want to talk with me for an hour, you can take a look at our coaching sessions. These are not free. It is a paid thing, okay? And we have our probability calculator here. And lastly, if you're thinking about a whole different strategy, if you're only good with buying options, specifically call options, take a look at this Warren Buffett report that I wrote. It's very interesting. All right, that's it for me today. We're getting on to about almost a half hour here. I make these free videos for the trading community, want to help everybody. Leave me a comment down below, okay? I love talking with you in the comments, but let's keep it civil. If you're going to make a nasty comment, at least defend your point. Okay, I'll definitely talk back and forth with you. Don't just leave nasty comments and then walk away, because that helps nobody. Down in the description below, I've got links and books and software and other websites that you can take a look at. I'll link another video on here about selling put options, and send me an email. If you want to talk to me, send me an email and we'll chat. All right, that's it. That's all for me today. I'll see everyone in the next one. This is Lee Lowell signing off.